Have you ever looked at the stock market and just felt confused? Like it's telling you two completely different stories at the exact same time? You see headlines screaming about all-time highs, but then you dig a little deeper and see a ton of weakness under the surface. It can be pretty jarring. So, what is actually going on? Right, and here's a perfect example of that confusion. It's a classic case of conflicting signals. The performance of small companies versus the big guys can paint a really murky picture. But listen, this isn't just random market noise. It's the market speaking to us in two totally distinct voices. And today, we're going to figure out how to translate what each one is really trying to tell us. Welcome to Everything You Need to Know About Finance. Now, before we dive into our investigation, just a really quick heads up. This is purely a deep dive for you to learn from. It is not financial advice. And hey, if you find this kind of breakdown interesting, do me a favor and hit that like and subscribe button. It makes a huge difference. Okay, let's get back to the mystery. So here it is. This is basically the scene of the crime. On any given day, you might see a picture just like this. The S&P 500, which tracks all the biggest companies, is chugging along nicely in the green. But the Russell 2000, which is our proxy for small companies, is down. And look, this isn't just a one-day thing. It's a pattern we've seen again and again over the past couple of years. And it creates this massive puzzle. Why are the giants thriving while the little guys are struggling? This is a huge clue about the real health of the economy. So, to solve this mystery, we need to get to know our two key witnesses, or, as I like to think of them, our two market informants. On one side, you have the Titan. That's the S&P 500. This is the established, powerful, globally recognized player. And on the other side, you've got the prospect, the Russell 2000. This one's the scrappy, ambitious, more homegrown up-and-comer. Their stories, their perspectives, they are completely different. And that's exactly why listening to both is so important. So let's start with our first informant. What's absolutely wild here is the sheer scale we're talking about. The S&P 500 isn't just some random list of companies. It's basically the benchmark for the entire large-cap US market. It's tracking 500 of the biggest players out there, and they account for a staggering 80% of the total stock market's value. We're talking about the behemoths, the NVIDIAs, Microsofts, and Apples of the world. They absolutely dominate this index. And then there's our other informant. The Russell 2000 is a totally different animal. It represents a completely different slice of the American economy. This index is made up of the 2,000 smallest stocks from a bigger list. These are your smaller, often younger companies that are hustling to become the titans of tomorrow. Okay, so we've met our informants. Now it's time for the really fun part, decoding their clues. What are their stories actually telling us about the economy as a whole? This table just lays out the key differences perfectly. Look at the Russell 2000. Small companies, mostly US-focused, way more volatile, and super sensitive to interest rates, mainly because they tend to carry more debt. The S&P 500, on the other hand, large, global, way less volatile, with much stronger balance sheets. This isn't just a boring list of attributes. It points to a fundamental theme. It's risk and growth versus stability and quality. And honestly, this might be the best way to think about it. The S&P 500 is like the backbone of a portfolio. It's there for stability and consistency. The Russell 2000, that's your accelerator. It's where you find the potential for absolutely explosive growth. But man, it comes with a much, much bumpier ride. And this is where it gets really interesting. The main battleground between these two is interest rates. It's the deciding factor. When rates are high, the smaller companies in the Russell really struggle. They've got more debt, and they have to refinance it at higher costs, which just eats into their profits. The giants in the S&P 500, they're sitting on piles of cash and can weather that storm much, much better. But the second you get even a hint that rates might start falling, that's when the Russell 2000 can just take off like a rocket, often outperforming like crazy. This difference also shows up in their profits. With the S&P 500, you're buying consistency. These are companies with high profit margins and pretty predictable earnings. The Russell 2000, though, offers what investors call optionality. Basically, the range of outcomes is massive. The earnings are way more volatile. You'll get some huge winners that drive the whole index up, but you also get a lot of companies that just don't make it. It's a real high-stakes, high-reward kind of game. So we've gathered all the clues from our two informants. We've heard both sides of the story. Now it's time for that aha moment. How do we combine these two different stories to get one single, clear signal about the market's true health? So after all that, what's the secret? How do you actually read the market's true mood? How do you cut through all the noise from their conflicting testimonies and find the real story? Well, the answer is surprisingly simple, and it's a tool the pros use constantly. You just look at the ratio of the two, the Russell 2000 divided by the S&P 500. This isn't just a math problem. It's a powerful signal about the market's real appetite for risk. And here's how you read it. It's super straightforward. If that ratio is rising, it means small cap stocks are outperforming the big ones. That's a great sign. It signals a healthy, broad-based rally where investors are feeling confident and spreading their money around. But if the ratio is falling, that signals a narrow and, frankly, a much riskier rally. It means a few mega cap stocks are doing all the heavy lifting while most of the market is just sitting on the sidelines. Okay, our investigation is just about wrapped up. Let's lay out the final verdict and talk about what these two market voices are telling all of us right now. So let's boil this all down to the crucial lessons. Think of it this way. If you want to know where money is hiding out for safety, you watch the S&P 500. If you want to see where money is rotating to make a bet on future growth, you watch the Russell 2000. Historically, the Russell does way better in early economic recoveries, while the S&P is the king during times of stress. But the real sign of a truly healthy, confident market, that's when you see both of them rising together, in unison. And that really brings us to the final question, which I'll just leave with you to think about. With everything we know about the economy right now and all the constant chatter about where interest rates are headed, which informant story are you going to be paying closer attention to? The stable titan or the ambitious prospect? Because how they move relative to each other tells a really fascinating story about where we could be headed next. Hey, if you want to keep decoding the markets with us, be sure to check out some of our latest episodes for more deep dives into the world of finance. Thanks for tuning in.